In this next module, we are going to start digging into the actual mechanics of bookkeeping and accounting. So the first big topic we're going to talk about is the accounting cycle itself, sometimes referred to as the accounting process. The idea here is that the life of a company, it may last, years and years, decades, some even last over a century, but that company is going to be broken into various periods of time because we want to see financial statements for certain periods of time or other reports. So we could have monthly periods, we could have quarterly periods, we could have annual periods, but the idea here is this accounting cycle that we're going to be talking about is completed for each period. So that'll make more sense once we go through that. So the first big topic that we're going to talk about here is known as the accounting cycle, sometimes referred to as the accounting process. There are a lot of different steps involved with this, and the one thing I want to mention here is that the level of detail for these steps is sometimes different in different textbooks, different courses, different instructors. Over the years, I've seen it about 3 different ways. Now, the order of all of these things has to be the same, but the question is when it's presented, do they merge some steps? Do they expand on others, break them out further? But again, it's the same order. It's just a question of what do they call a step. One step for one person might actually be broken into 2 or 3 different steps for another person. So the same basic order here. We're going to see this, and we're going to go through what I call step 1. Now this is step 1 for anybody. You have to analyze the transaction at hand. And the idea here is that you're taking a look at what has happened throughout the period, and you're reviewing source documents, receipts, invoices, any sort of document telling you that a transaction has happened, tells you the amount, tells you what parties were involved, what dates this took place on, and you analyze this to take a look at what transaction actually happened. Now what you do here, you identify what accounts, based on the accounts that company uses, what accounts have actually been impacted, and have they been increased or decreased. Now, when we see this step, we talk about the accounting equation. Now, one of the videos that I'll be referring to goes through a practice exercise of the accounting equation and this transaction analysis, basically saying, hey, cash increased, revenue increased, I'm still in balance across the board. But we don't need to get into that detail right now. The point is, we're taking a look at what accounts do we have and how were they impacted. Step 2, now we translate that increase or decrease into a debit or a credit. Now, this gets in a normal balance that we'll talk about in a few slides. You have to know the normal balance of an account before you know whether an increase needs to be a debit or a credit or whatever. So that comes later. But in step 2, we create the journal entry. It's called recording the journal entry or just journalizing. This is a chronological record of the transactions that have taken place throughout the period. And the point here is you just know what accounts, for this one transaction, what accounts were impacted and were they debited or credited. Now again, we already talked about whether something was increased or decreased. Now we're translating that to a debit or credit, which will make a lot more sense in a few slides when we talk about normal balances. I want to throw out right now that debits do not always increase any account in general, and they do not always decrease every account. You have to know the type of account and what its normal balance is. Again, stick with me for a little bit and that'll make more sense. When we do a journal entry, it's important to know that you're going to at least have 2 lines to that journal entry. You might have 3 or 4 or 5, it doesn't matter. But the quantity of the debit entries, so you could have, like, for example, 2 debit lines, 3 credit lines, that doesn't have to match. The number of lines doesn't have to match. The number of accounts debited versus the accounts credited doesn't have to match. But the dollar amount for this one journal entry, the dollar amount of debits versus the dollar amount of credits in total for that journal entry must match. Again, we'll see that in some examples later on. Step 3. We're going to take each piece, each line of that journal entry, and we're going to post them to the ledger. The ledger, every account is found in the ledger. It's its own little record of all the increases and decreases to that one account, all the debits and credits to just that one account. That way you know what the total balance is. So as an example, if a particular entry required us to debit cash and credit revenue, then what I'll tell you right now, what that would basically mean is that we earned revenue and collected cash right away. Later on, you'll get more used to that. But the point is, the debit to the cash account would be posted to that general ledger cash account to update the corresponding balance. As we'll see later, a debit actually increases cash, so now we know we have more cash. And you take a look at all the debits and credits that have happened to cash, and you end up with a running total balance. Then you can prepare the unadjusted trial balance after you get all your journal entries created and posted. Then you now know the balance of every single account, and your unadjusted trial balance is just basically a list of all of the balances that every account has. It has no detail behind it. It's just the final balance of every individual account. Now, some of those accounts are going to have a debit balance. Some of those accounts are going to have a credit balance. The total debits and the total credits for that trial balance must equal. That's one of the rules, and we're going to see that when we see the examples later on. Right now, we're just running through the steps. We're going to see examples for this later. Now, step 5. We're going back and we're preparing some more adjusting journal entries. So notice that step 5 is the combination of two things. It's recording the adjusting journal entries and posting them. Again, some texts might break those out into two completely separate steps, but for simplicity, since we already know the difference now between recording a journal entry and posting it, we're just kind of merging them together, and we're just calling this step the adjusting entries. These entries are necessary to ensure that we're recording revenues and expenses in the proper period. It's the accrual basis of accounting that we started to talk about a little bit last module. The point here is, for example, if you bought some supplies, you bought prepaid rent, you paid for rent in advance, that was not a revenue, that was not an expense at the time, but now that we've used it up, time has passed, now it's a rent expense. So we need to do an adjusting journal entry to record that. What unearned revenue has now been earned? We need to count that as revenue this period. What expenses or liabilities have been accrued throughout the period? For example, salaries payable. We now owe our employees money, so we record a salaries expense and a salaries payable. That's an adjusting journal entry. And then what revenues and assets have been accrued throughout the period. Just think of interest. We had money in the bank. We know we've earned money because time has passed, but we just haven't received it yet. So that's an example of a revenue and asset adjusting journal entry. Keep in mind that we're going to see adjusting journal entries later on. Examples of them. Step 6, now we're taking those balances after all the adjusting entries, and we're preparing a second trial balance, the adjusted trial balance. Has the same basic purpose as the first trial balance. The only difference is now we're using this data for the financial statements, whereas before we were just doing a regular journal entry. In order to help us do the adjusting entries, we needed to know the first trial balance, and then we figured out, well, what has actually happened that needs to be recorded now. So we use this adjusted trial balance for the financial statements. So step 7 now, we're going to prepare the financial statements. Those 4 financial statements we talked about in Module 1, we have to do them in the order that is listed. And we're basically just pulling amounts from the adjusted trial balance. Of course, you're going to have subtotals like total assets, total liabilities, all of that. But the individual account balances come from the adjusted trial balance. Then step 8. we're preparing and posting closing entries. So another set of entries, and again, we've merged the recording and the posting of journal entries together. You could see this broken out into 2 steps. That's fine. Now, the point here with these closing entries is that some accounts need to be closed down to 0 so they start the next period fresh. Other accounts, they keep a balance forever, permanently. Revenues, expenses, and dividends, they restart every period, so they need to be closed down. They're all closed to retained earnings, which, by the way, we'll see I guess we already saw the retained earnings statement. We talked about that in Module 1, and that's basically a replication of this closing process, if you want to think of it that way. The closing entries basically mimic the retained earnings statement. That's what I'm essentially saying there. And by that, we say beginning retained earnings plus the net income, which was revenues minus expenses, subtract out dividends. That gives you the ending retained earnings balance. The balance sheet accounts are what's called as permanent accounts. They must keep a balance. The assets, the liabilities, and the overall equity items, they keep their balance. They don't restart the period with 0. So the closing entries allow us to get rid of the revenues, expenses, and dividends and find out the final balance of assets, liabilities, and equity. And then we're going to prepare the post-closing trial balance. This is the 3rd trial balance now, after, of course, the closing entries have been posted. And this one is a little bit different because it only contains balance sheet accounts. The revenues, expenses, and dividends are gone. The other main difference for this one is that the retained earnings balance is now different than it was before because accounts have been closed out to it. As with the other 2 trial balances, we need to make sure that the debits and credits still keep a balance. Now, this step 10 is an optional step. Now, some computerized systems do this, but manually it's not quite as common. Relatively few companies use this, but the whole point of this is that some companies, they're forced to use the accrual basis of accounting, which shows that, hey, you have a salaries expense even though you haven't paid the employees yet. It shows that, hey, you've accrued interest revenue even though you haven't collected it yet. Basically, all those accrual-based adjusting entries that we did a few steps ago in order to prepare financial statements, the reversing entries reverse it. They get rid of those adjusting entries. Now, that's fine, but the company, the next time right before they do financial statements, they'll have to do those same adjusting entries again to get it right back to where it needs to be. Some companies just don't want to see things unless the cash has been received or the cash has been paid. So they reverse the adjusting entries out and they basically bring it back to the cash basis of accounting. And now next time, again, next period, we'd have to do adjusting entries again. But if they want to reverse it in the meantime, that's completely up to them. So that is the accounting cycle as far as a high-level overview. Now we're going to start to get into some of the detail with it. And for a lot of this to make sense, we have to understand, first of all, how to balance an account, how to determine what the balance is, and second of all, how to determine the normal balance of the account. Normal basically means, should this be a debit or should this be a credit? Now, any account, I intentionally left the account name out, so we don't know which account that is, and that's fine. Any account, the way to determine what the final dollar balance is, you take either side. You can start with either side, but you sum up both sides individually, and you determine which side has the most. Here, the debits, they have 400 total debits, 350 total credits, so there are 50 more debits than credits. That means they have a $50 debit balance. So that's what matters there. $50 debit balance. Now, this other account, notice we've added, it's a different account altogether. We only had 150 debits if you add these up, 150 debits. but we had 300 credits. So this particular account has 150 more credits than debits. So that's their balance. Now that's just a straight balance. We don't know whether this is positive or negative because we don't know the account name. We don't know what the normal balance should be. Again, we just know this account has a $50 debit balance. This account has a $150 credit balance. That's all we know. To determine whether that means positive or negative, we have to know the normal kind of expected balance of that account. Once you know that, whether it should be a debit or it should be a credit, you now know also how to increase it. And then, of course, you do the exact opposite to decrease it. So anything that ends up with a balance on its normal side is positive. If it ends up with a balance on the wrong side, it's negative. So now we're going to learn how to determine the normal balance of accounts. And we're going to start with something we learned in Module 1, the basic accounting equation. We said that assets must equal liabilities plus equity. Assets, of course, are those resources that the company owns. And liabilities and equities both represent claims to those resources. Either creditors have the claims to the resources for the amount you borrowed from them, or owners, through equity, have a claim to those resources for essentially whatever's left. The other way to think about this is that the resources must equal the method of financing that they use to purchase the resources. So where did they get the money? Did they borrow it, or did they have somebody invest money through stock? Now, to get into the normal balances, we're going to have to break out the accounting equation a bit. We start with assets and liabilities. Those are kind of the base level. But then owner's equity can quickly be broken into two account types: contributed capital, or paid-in capital, common stock, a variety of terms for it, plus retained earnings, or earned capital. Now notice the ones I'm highlighting in red, I'm basically saying, hey, that's as far as we're going to break it out. These are an account type we're going to talk about. Retained earnings can easily be broken out into three different items. Of course, beginning retained earnings, that's our starting point, plus net income, again, revenues minus expenses, which we'll see down below, and then dividends. Dividends get subtracted immediately out of retained earnings. So notice the bottom, the things that can't be broken out much further, I've highlighted those in red. The idea here is that these are the 6 core account types we're going to talk about for normal balance rules. So assets are on one side of the equation, liabilities and equity are on the other. Accounting is all about balancing, so it makes sense that assets on one side have one set of normal balance rules, and liabilities and equities on the other side have a different set of normal balance rules. So that's what we're seeing here. So the assets are increased by debits. The liabilities and equities are increased by credits. Now, whatever an account is increased by, it's obviously decreased by the opposite. So if you remember this, assets are increased by debits, therefore they're decreased by credits. But liabilities and equity have the exact opposite. They're increased by credits, therefore decreased by debits. Whatever they're increased by, that's its normal balance. Now let's break out equity a bit. Equity, the normal rule, is that it's increased by a credit, decreased by a debit. But let's look at the different components of equity. Capital, paid-in capital, contributed capital, whatever term you want to use, common stock. When you increase capital, you also increase equity. So it's increased by a credit, because that same credit increases equity. Revenues, it's the exact same. When you increase a revenue, you increase net income, which increases retained earnings, which increases equity. So revenues increase equity, so they're going to have the same normal balance rule. A credit to revenue also ends up increasing equity. But then we look at the last two. They act the opposite way. When you increase an expense, That decreases net income and decreases retained earnings and therefore decreases equity. So if you debit an expense, that's the normal balance of an expense. A debit increases an expense because that same debit that increases the expense ends up decreasing equity. That's why it has an opposite normal balance rule from equity overall. Dividends, same thing. The only difference is dividends don't impact net income. They go straight to retained earnings. If you debit a dividend to increase it, that debit decreases equity and it decreases retained earnings. So the normal balance of dividends and expenses is a debit, very similar to the assets. So what this leaves us essentially with is 3 of our accounts that have normal debit balances and 3 that have normal credit balances. Now, I will say I do, in the textbook that we're discussing, I have a video that focuses in on these normal balances. It's a practice exercise. I strongly suggest you take a look at that because it'll really help to refine that and make sure you have plenty of practice with it. Now, a couple of important notes here. Well, one important note really about dividends. Dividends are not expenses. This is something that threw me off in my very first week of accounting courses. Dividends are not expenses. They don't impact net income whatsoever. They just go straight to retained earnings. So that's the important note. Don't call it dividends expense. There is no such thing. Now, the little, increase, decrease, the arrows, that's one way to learn the normal balance rules. The way I actually learned it when I first took my accounting course was through a mnemonic device that's really stuck with me all these years. So I want to share that. The first one was the mnemonic device I learned. There wasn't really a good mnemonic for the second one, but we'll talk about what I made up. So, DED is the mnemonic for the debit accounts. Now, before we get into this mnemonic, though, I wanted to mention, remember we have 6 accounts. Assets, liabilities, and then we had revenues, expenses, capital or common stock, and then dividends, sometimes known as drawing. Those are the 6 accounts we're going to talk about. The DED mnemonic tells us which mnemonic or which accounts have a normal debit balance. D, the debit is the first D in DED. Debit accounts include expenses, assets, and dividends. Now, there are 3 accounts for the credit side. The best mnemonic I can think of is clerk, like an accounting clerk. If you take an accounting, you're a little stressed about it. You may think it's going to kill you, but it really isn't. So, dead clerk, you don't want to be a dead accounting clerk. So, clerk. Again, accounting's not going to kill you. It just takes a little bit of practice. But this tells us that the credit accounts, that's the C in clerk, CLRC, the credit accounts include liabilities, revenues, and capital or common stock. So this is something, again, I like learning with mnemonics. Makes it easy to remember. That's their intent. So if you want to use this or if you want to use the past few slides or both, whichever works for you. But let's take a look at this in action. Cash has a normal balance on the debit side, and this particular setup ends up being on the debit side, the balance, because there are 150 more debits than credits. So that's good for cash. We want it to be on the debit side, so this has a positive balance. But now, let's see, we switched from 500 to 700. We added 2 more hundred. That increased our account. Previously, there was just a 150 balance, but now there are 200 more debits than there were before, so that means it's 350. The credit side didn't change. But now notice we added 200 on the credit side, so the difference between the 2 accounts is less. Now we're back to 150 balance. That's the difference between the 2. We're still on the debit side, so it's still positive. Until now. We added 200 more credits, so now our balance has flipped onto the credit side because we have 50 more credits than we do debits. So this balance is $50 credit for cash. For cash, that's not a good thing. That means we have a negative balance. Now, you think, how would we possibly get a negative balance for cash? The only theoretical way that could happen is if this company, like, bounced a check, overdrew a check. Again, they never want to do that, but that's the only theoretical way this can happen. So they want to correct this issue very quickly. But that's the point. It ends up on the abnormal side, so it's a negative balance. You don't see negatives anywhere in the T account. By the way, that's the word for this, a T account. It's just a quick representation of a ledger. You'd never see a negative number here. It's all defined by debit or credit. So the question you may have when you're looking at that checking account register that we'll see in just a bit, why does it show that deposits are actually credits and withdrawals are debits? That seems to be the exact opposite of what we just said it should be a bit ago. So that's what we're going to see here. Here is a picture of a checking account register. And you'll notice that a payment or a withdrawal shows up as a debit. A deposit shows up as a credit. But that's the exact opposite of what we just said. The reason for that is that what you're seeing here, this checking account or the savings account or whatever bank account you might have, to you it's a cash account. To the bank, it's a liability. And these registers, the bank statement, all of that is coming from the bank's perspective because they're doing the accounting. Your cash account is the bank's liability account. If you deposit money into that account, the bank knows they owe you that money back. Liabilities, which it is from their perspective, that has a normal credit balance. So if you deposit money, you increase their liability at the same time that you're increasing your own cash, and to them, it's going to be a credit. You're increasing their liability. When you withdraw money or spend money, you're decreasing that liability. They no longer owe you it because you've already used it. That debits their liability to decrease it, and that's why it ends up showing up the way it is. It's coming from the bank's perspective, not your own perspective. Understanding these normal balances, the debits and credits, that's very key to understanding accounting. You really can't get much further without hammering that down and truly understanding it. It's the basic language of accounting. That's how all of our journal entries are going to be recorded. That's how account balances are maintained. Again, they don't tell you negative or positive. Everything shows up as a positive number, an absolute value. But knowing whether it's a debit or credit and what it should have been, that tells you whether in your mind it's positive or negative. Now, you've heard the term debit and credit before, I'm sure, somewhere. Debit cards, credit cards, things like extra credit. Credit always seems like a good thing, seems like a positive. You're getting credit for something. I'm going to credit you for this. But it's not always that way. The verbiage, the way it's been used in basic life, if you will, versus accounting, sometimes gets a little bit twisted around. And I just talked about the checking account register, so we'll go through some examples. But again, don't get confused by those terms. You really need to understand the normal balance rules that we just talked about. And we just said that debits and credits are opposites. If a particular account is increased by a debit, it must be decreased by a credit. Some of the accounts, the 3 accounts that we talked about, are increased by debits. 3 accounts are increased by credits, and those are the normal balance rules that we talked about. Now, that's where we're going to stop for this part. We're going to come right back and do part 2 of this module 2, and we're going to start looking at some actual journal entries here.